Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, John. It's fantastic to have you on the podcast.
Nice to be here.
Great. And first of all, kudos for writing such an excellent book, The Problem of 12, which we'll be focusing on in this discussion. But before we go and talk about the book, I do like to learn something about my guests. So what is your origin story? What did you study at college? Was it inevitable you'd end up in academia and law and economics at this intersection of law and economics? What's your story?
So not at all inevitable. I majored in history at the University of Virginia. I chose an incredibly practical topic, early medieval, which turned out to surprisingly not have a giant job market attached to it. So then went to law school, where I, like most law students, I think, initially thought courts and that sort of thing, but I got some good advice from a father of a friend who said, "Why do you want to be a lawyer after it's already become a big mess and you're in court fighting? Why not be a lawyer earlier in the cycle of the kinds of things that produce disputes?" And so I thought about that, and I thought that sounded sensible, and so I became, an advisory lawyer doing principally financial legal work, mergers and acquisitions, corporate governance, and the like. I did that for a long time on Wall Street at a law firm called Wachtell Lipton, which is principally an M&A firm. And that was my path into my current role, which is teaching the same topics, but also teaching finance at the business school and financial accounting to lawyers and thinking more broadly about financial regulation. And then very late in my career, after I've been in Harvard for 25 years, took a job at the SEC, which further broadened my sort of thinking about the overall topic. So that's my personal origin story. And then just to complete your answer for the book itself, a few years ago, I taught for a couple of years in a row at the business school in their MBA program. And through that, got asked to help write a basic primer for the MBAs about corporate governance. And Suraj Srinivasan, who's a professor at the business school, and I put something together, and it's pretty basic. It just sort of covers the main institutions and ways in which public companies primarily are governed. And then at the end of that, we were asked, well, what's changing? What might be over the horizon? And so that sort of forced me to think about my career and what had changed. And I settled on three things that we included in that in very short little snippets. One was globalization, which this book has nothing really much to do with, but the other two were the rise of index funds and the rise of private equity. And that kind of was the moment that crystallized for me why this would be an important and discrete topic. Of the many, many changes since the 80s. Those two funds and their rise have had, I think, more dramatic and systematic impacts on the way every large business that raises public capital in the case of index funds, or even stays private in the case of private equity funds, is likely to function over its life cycle.
Yeah, that's fantastic. Yeah, and the book's called The Problem of 12, when a few financial institutions control everything, and it's well worth a read. Now, in terms of the book, something you do talk about is the rise and the role of the public company in the US economy. And I guess also this applies to Western economies in general, or developed economies at large. So why did you start off by talking about the public company? I mean, what's in your eyes, what's the significance and what's a paradigm shift around having public companies at the sort of the central sort of part of an economy?
Well, I think there's two connections to the overall themes of the book. One is just the basic practical point that for the bulk of the 20th century, large publicly held listed companies were the dominant forms of business, controlling certainly in excess of half and usually 2/3 of the economy, depending on how you measure it. Exxon, Apple, Conoco go down the list of major companies in any given sector, while startups and mid caps are important players, and family-owned firms are still important in some sectors, and there are even occasionally still very large, purely privately held companies like Cargill. For the most part, the economy in all sectors is dominated by the public company. So that's one reason, just to retell the basic story of how the public company came to play that role, because then, as you know from the rest of the book, the story I'm telling really in the book is how that's been transformed as a result of the rise of these two asset management forms of enterprise. The other reason for laying out the backstory of the public company is there is, I think, an unappreciated repeat problem, that the problem of 12, which is this book, is an example of, but it's not the first example. And there's a basic trade-off, a dilemma, a clash between economies of scale, which are very important in finance generally, and the concentration that flows from economies of scale on the one hand, and democracy and a commitment to a divided government and checks and balances, and not having any particular organizations dominate the polity, including the economy through the polity or the polity through the economy. And so that basic clash first played out with banks way back in the 18th century, and then again with insurance companies. And public companies are another version of this, because public companies first arose because the capital needs of large enterprise in the late 19th century generally started to exceed the wealth of any one person or even a family of people. So you got the publicly listed company as a way to pool capital from dispersed investors. That represents a type of economy of scale. Exxon has its origins in Standard Oil, which was, at one point controlled 90% of the world's oil supply. And it was one massive company that did have a public float. It was controlled by the Rockefellers, but it was, it had very many dispersed investors. And I don't think it could have risen to its scale and importance without the public company structure that it embraced. So that's the other reason to start with the public company.
And in terms of corporate governance, obviously there's been a system of checks and balances to, I guess, contain the power of these public companies, and also to deal with the principal agent problem of, managers versus shareholders. And so if we take that from the post-war period onwards, I mean, how would you, describe how that's evolved and what stage we are at, in terms of corporate governance?
Yeah. So I think an unappreciated fact in people's memory is, up to the eve of World War II, the question of whether capitalism would survive as an important way to organize the economy was still very much up in the air. There were many people, even readers of Forbes and Fortune magazines, that were thinking, well, maybe socialism isn't so bad. Capitalism in the 30s, of course, went through the misery of the Great Depression, and at the same time, the economy was already dominated by these large public companies, in which individual managers who only owned a tiny fraction of the stock of the company were the dominant players. And as you alluded, massive agency problems almost certainly existed at the time. So you had the combination of bad overall economic performance with a structure which didn't really have a lot of legitimacy, in the sense that it gave enormous clout over the entire economy to a small number of unelected managers who were doing a bad job anyway. So that's sort of the pre-World War II setting. Now, post-World War II and on through the end of the 20th century, public companies did better. The economy got back on a better path coming out of World War II, partly because public companies did play an important role in the war itself. They also, embraced forms of regulation and checks and balances in various forms. We don't usually think of big companies liking unions, but they were willing to work with unions to some extent in the middle part of the 20th century because that was a way to achieve both labor peace and the ability to manage, but also some legitimacy and accountability to the broader public. I think an even more important component of that period was the disclosure regimes that were expanded certainly in the U.S. starting in the middle part of the 20th century. The UK has a little bit longer experience with disclosure as a tool in this space, but for the U.S., much of the economy didn't really have what we think of today as a fully transparent disclosure regime, really until the late 40s when the SEC regime got stood up for listed companies, and then the 50s and 60s when it got expanded to large unlisted but public companies. So that's a second component. And a third thing I would say is that the corporate managers, the agents themselves, recognized they had an agency problem and that they weren't trusted. And they, increasingly were at least willing to work with various forms of checks and balances on their own power. They don't like hostile takeovers, and they resisted them through attempted regulation. But at the end of the day, were willing to accept that sometimes proxy fights, takeovers, various forms of control contests could be a check on their power. And that also emerged in the middle part of the 20th century. That's sort of the middle part of the story. And then, the book then picks all that up with the 1970s and tells the story really forward.
And so yeah, I mean, let's pick it up from there. So, we kind of had this sort of special period after the war with things generally everywhere were going quite well. Then you had the 70s and you had, inflation, the breakdown of Bretton Woods from a macro perspective, also social unrest. From a company perspective, what was going on there? Obviously, we know the macro backdrop. We had the oil shocks, and there was questions on monetary policy. Bretton Woods has broken down. What was the challenge to companies at that point?
Well, I think there were two, maybe three really big challenges to ordinary public company governance from the late 60s, but especially picking up in the 70s and then getting just into a maelstrom in the 80s. And they were inflation, which is a partial side effect of the macro events that you're describing. Globalization, the US and other Western countries had been committed to free trade coming out of World War II and remained committed to it. I think for the most part, it didn't really have significant effects on companies until the late 60s and then picking up into the 70s. And famously, of course, Japan started buying up the world in the late 70s and into the 80s. The German and Japanese engineering brilliance started to eat away at the basic capacities of more and more U.S. manufacturing companies, and then increasingly low-cost labor locations like Mexico and China attracted more and more business. And that then put a lot of pressure on U.S. companies. They either had to adapt by doing themselves the same kind of outsourcing and offshoring, which would then have big effects locally, or they risked having their valuations flatline or decline and attracting hostile takeovers. And there was a mix. So companies did both. And the result of that was the 80s was probably the peak period of massive conflict over public company governance, because something like a third of all Fortune 500 companies were subject to hostile takeover during that period.
Wow, I didn't realize that it was that much.
It was truly.
It's hard to imagine that now.
Yes, I mean we live with activism today. We think of it as a major force, but by comparison, the 80s were a much more both dramatic and traumatic period for anyone working at a public company, at least in the U.S. and the UK. You could tell it's sort of a different story, I would say, for the continent. Their ownership structures have never conduced to hostile takeovers, but they had their own struggles with globalization's effects. So that's the second. Inflation, that was a big challenge. Globalization, second. And then related very closely to globalization was automation, and increasingly the ability to invest in particular kinds of automated ways of functioning, um, but with very important differential effects on companies depending on what choices they made. And you put all that together, and you had a period in which I would say, after the high point of the 60s, the credibility and legitimacy of the governance of public companies fell again. Not as far down as, say, the 30s, but nevertheless, it was really called into question. And it's truly this is an important period for a major foundation of the story I tell in the book, because um, institutional investors um, really became organized, at least in the US, for the first time. In the UK, they'd been organized earlier, and they had an influence over the takeover code. In the US, they were still largely politically inactive up until the takeover wave. And it was largely because of the takeover wave that they got active. Managers of companies started paying themselves giant golden parachutes, or worse, in the perspective of shareholders, paying greenmail to make takeover raters go away. So in a sense, overpaying one rater shareholder at the expense of other shareholders. And so the institutions banded together to fight some of the abuses that they perceived that agents of their public companies were engaged in response to takeovers. And that has persisted. So to this day, institutional shareholders now are politically organized and active in a way that was not true in the U.S. prior to 1980. And that then means that when you get to the rise of the index funds, which really take off after the year 2000, it's in a context in which politics and finance are already quite intermingled, and can affect each other in ways that make the current moment one of great, I think, uncertainty about how it's going to play out with the rise of index funds.
And all of these shifts you just described, is that linked to Reaganomics and Thatcherism, or not? Or would you say, it would kind of happen anyway? I mean, this is counterfactual we're talking about now, but
Yeah, I think the three big forces, inflation, globalization, and automation, would have happened anyway.
yeah.
I think Reaganism and Thatcherite economy, sort of, attempts um, to shift public policy in response to those forces were themselves important. I mean, don't get me wrong; they were also an important set of conditions. But Reaganism, interestingly, I actually don't know enough about Thatcher's particular politics on this issue, but in the US, Reagan's approach and his cabinet were deeply divided over corporate governance. On the one hand, Republicans, including Reagan, had long been traditionally allies of big business, including managers of public companies. And so they were allies with the Chamber of Commerce and the Business Roundtable, and other political trade groups. But they also were very committed to markets. And hostile takeovers is a form of a market. It's a market for control of companies. And so they actually were quite paralyzed at the federal level. Reaganism didn't really intervene in a significant way in the 80s in the events that I was just describing. And that's part of why the institutional shareholders felt they had to politically mobilize, because nothing was really coming out of Washington. Those events divided both parties, really. The Democrats, I would say largely more pro-labor even through the 80s. But at the same time, what does that mean in a setting where if you preserve wage rates only to have companies go bankrupt and offshore the same jobs, that's also a problem. So there really was kind of not a clear path for, I think, either political party in response to the way in which public companies were caught up in that maelstrom in the 70s and 80s.
And I'm just thinking of movies here, Wall Street, obviously, with Gordon Gekko, and in some ways that characterized the decade quite well, where you have a corporate raider, which I guess today would be called private equity, I suppose, but the terminology back then was different. taking on, it was an airplane, it was an airline, I think it was, and
It
then there
was,
was the
yes.
union issues, and
Yep.
everything was contested there. Then you had competing raiders, but I think in some ways, for me, that kind of that kind of echoes what you're describing here for the 80s.
Yeah, the movie is a good movie. It has a lot of truth to it. Like most Hollywood movies, it wants to paint things a little bit more black and white than I
Yeah.
think the truth was. For example, you know, um, he didn't really want to buy the company. He just wanted to make money by, what we would today think of front running and scalping and insider trading. He wasn't really interested in running the airline, although he gives that great speech about greed being good. And likewise, the unions, often did take anti-takeover positions because they understood that a natural consequence of a raid might be, a sudden round of layoffs. But they quickly realized that even if they succeeded in warding off a gecko, that the existing CEO of the company could turn around and do exactly the same thing that the raider did. And so while there was a brief political alliance there between incumbent management and unions, that broke apart very rapidly in the late 80s and early 90s. And so the movie's it's an interesting window on a time. Another one I would suggest for your listeners, if they want to get a little more flavor of the period, is Barbarians at the Gate, which is an HBO. So it got maybe a little less publicity, but it's about the RJR buyout, and that really is about private equity. That one is actually even more realistic in its details, I will say, having lived through the period myself.
Okay, great. Okay, that's good. Two good film references there. Now, you talked about index funds. So, if we fast forward to the 2000s, we have the rise of index funds. I mean, first of all, why did index funds, become so popular, and why the 2000s did they become so big? And then
Yeah,
how does it intersect then with this governance question?
so index funds owe their origins to some wonky academics at Chicago and MIT and Harvard back in the 60s. And they, having been pouring at the asset prices, stock prices, for example, of the middle part of the 20th century, concluded that it's really hard to predict the path of the stock market. Even if you really leaned into fundamental analysis, it's actually very difficult to earn a return in excess of what you'd get if you just simply bought every company in the market or a large chunk of them. Diversification is an idea that emerged in this period. And taken to its limit, the idea would be you stop trying to pick and choose companies to invest in, and you just buy them all. And so then the great thing about that is you don't have to pay expensive portfolio managers to pick and choose anymore. You just simply go and get the list and buy them all. That's really cheap to do in the sense it's got expenses. You got a custody and you got safeguarding the assets, and companies get taken over, so you have to take the proceeds and reinvest them. So it's not a zero cost strategy, but it's a much lower cost way of investing than paying very expensive professionals to do fundamental analysis for you. All right, so that's the idea. It's a little bit counterintuitive. I'm going to turn my money over to somebody who is not going to try to do a good job. They're going to just do the even more basic job of safeguarding my money, but that's really it. Jack Bogle started Vanguard in the early 70s based on this idea. Everybody thought he was a little crazy. He remained a bit of a joke on Wall Street through the mid 80s, and yet he grew Vanguard slowly, incrementally during that period, because it turns out the academic theories are pretty right now that we've got even more data to look at. And by the time you get to the year 2000, you've got a long sustained set of observations that you can run regressions on and look at it in 1,000 different ways. And while there are people, listeners shouldn't get me wrong, there are people who have been able to beat the market continuously over long periods of time. They're in the minority, a very small minority of all professional money managers. And for most other investors who are not professionals, figuring out who the good ones are and who the average ones are and who the bulk of the under average ones are, the distribution is skewed. is itself a problem. Like, how do I know? And the reason it's hard to tell is because in any given year, the outcomes of investments are quite noisy. And so it might just be luck that somebody does well, even for a 3 or 4 year period. You think they're great, you give them their money, and then in year 5 and year 6, suddenly regression to the mean, and now you're not doing so well anymore. So for the average investor to pay the fees associated with active management is a bit of a gamble. And the pitch of the index funds for now 50 years has been, give us your money. We won't spend much at all of it. In fact, today you can get an index fund for free. They literally don't even charge an asset management fee. They're trying to cross-sell you on other things as part of that. So it's not truly free, but it's pretty close to free. And you'll get diversified investment that will do as well as the market, which turns out to be better than most professional managers. So that's the basic business model. Why did it take off? I think there are a couple of answers. One thing, just, maybe this is an obvious point, but it takes a long time to convince retail investors to change. They don't like thinking about it. It's complicated. It's not what they do for a day job. That's why they need to turn it over to somebody else. And so to get a change, substantial change in the way people think about how to invest for their retirement, it took decades of slow, persistent salesmanship coupled with the business story that I just gave you. Another thing that changed was increasingly prominently famous people embraced indexing. So, there are lots of examples I could tell, but the one I like the best is Warren Buffett somehow was in a room with LeBron James, the NBA player, the equivalent of Lionel Messi, for those of you who don't follow basketball. And James asked Buffett, said, look, I'm an athlete. I've earned a lot of money already, but I don't know how to invest. Lots of athletes get burned. What should I do? And Buffett famously said, according to James's later interview, to just put an index fund. And apparently LeBron did that. And, 10 years later, he's a billionaire, and it's because the market's done pretty well over that period. And he's not had to pay fees, and he's not had to expose his wealth to the risks that come with active managers. So those kinds of voices in prominent places, kind of spreading this basic idea and getting over the counterintuitive element of it, I think has led to indexing's sort of dramatic rise. One last little point, which is maybe even more important but less fun, is institutions make choices. For example, when individuals who work for U.S. companies are given choice about how to invest through the company's own investment plans, those gatekeepers have increasingly flipped from active to indexing as the default. You're still allowed sometimes to pick active management, but if you don't do anything, and a lot of people just are passive and leave it where it is, it now typically goes into an index fund, whereas that was not true in 1995.
So you put all 401k, the pension contribution.
You got it. Yeah, exactly. Like any amounts that you're investing through your employer over and above whatever social savings is going on. And then I should also say, I mentioned the other institutions like pension funds and superannuation funds and the like. They also increasingly invest through indexing as well because of the basic business pitch that I just gave you. Even they recognize it's hard for them to pick active managers well. So you put all that together, and the basic core story in the book that I lay out, with details on data, is from year 2000 on, index funds, assets under management have grown at a compound annual growth rate in the, somewhere between 12 and 20%, around 15%, pretty persistently year on year. And that's of course vastly faster than the economy, vastly faster than investments overall. And so they've increasingly become the dominant forms of investment. And then for governance purposes, and this is the real key, massive economies of scale, to go back to that theme, are associated with indexed investing. Active, it's actually hard to invest well as you get more money, because if you're picking and choosing and you get more money, well, that might actually drive down your return on some of the things you've already chosen. With indexing, since you're just buying everything, you've got a huge fixed cost to create the engine, but for every marginal dollar you add to your overall machine, it's pretty trivial to add another dollar to the Vanguard machine. So huge economies of scale when you have that kind of a structure. Big fixed cost followed by really low marginal cost means they can keep growing faster and faster. And actually, it makes them even better because per dollar for their investors, they're able to deliver the same thing at a cheaper all-in cost. So the bigger they get, the better they get. And then that obviously becomes a cycle that feeds on itself. And that's really what we've seen. And it produces not just index funds, like there's not 500 of them, there's 3 or 4. And that's a very different world than 1995. Back then, we had institutional investors, but there were hundreds of them. Now we've got index funds, and they're really just a small number of major players. It's very difficult to compete with them because of the economies of scale that they experience. If somebody today wanted to create a new index fund family, they would find it very difficult to break into that market. So you've got Vanguard, BlackRock, State Street, and Fidelity in the U.S. In Europe, you throw in, Deutsche Bank, and then Canada Bank, Bank of Montreal, and a few others around the world. It's fewer than a dozen, the problem of 12. They control now already the top 3 or 4 control 20 to 25, sometimes as much as 30% of all the stock of every single listed company. So that's the landing point here. A dozen people or fewer control essentially the pivotal votes in corporate governance elections where they want to take a common position. And almost no one else can outvote them, including management, including hedge funds, including other types of investors. You put aside the small number of companies that have dual class super voting shares, put them aside. Every other company that's listed on the New York Stock Exchange has index funds as their biggest shareholders, and collectively they're the swing vote when there's a disputed election. And that's a dramatically new thing about corporate governance. It was not true 25 years ago. It gets bigger over time, and I don't see any natural financial equilibrium pushing back. The economies of scale, I don't think, are going to run out until they get past 50%. And when they get past 50%, they determine who's on the board. So that's a pretty dramatic change. It's, if you will, a takeover of the entire public company universe. In the 80s, they were fighting about individual company takeovers. Now we've got just a few groups of people controlling every company, or at least having the potential to do so. So that's.
These index funds are called passive. that's, I'm from the financial industry. We call this passive money versus active money. So, when they end up owning, you get the impression that they almost by accident end up owning large chunks of companies, which implies that they aren't actively engaged in the governance of the companies that they have a share in. Now, how do they engage with the companies they have shares in then?
It's absolutely, those are all correct points. The strategy is meant to be low cost and passive. That's true on the stock picking side, but on the governance side, they have obligations to not just ignore the companies they own. They actually, as agents, have responsibilities to pay attention and to vote and so on. They probably, frankly, in secret would say, we'd be happy to get rid of all these votes. We don't really like this whole voting thing. It's not really what we are in business for, but they have it anyway, and at least under our current legal system. And so how do they engage? Well, they have staffs. They're not nearly as big as the people they've displaced, but they've got 50 to 100 people each who spend their full-time jobs thinking about the governance of every company in the listed company universe. Now, on a per company basis, that means they spend, a couple hours a year thinking about each company. They probably overweight the bigger companies because they're more important. And then they do lean in, I would say, in important moments. So they will engage, meaning meet with, call up, have a back and forth with the management of a company that's underperforming in a serious way, that's confronted, say, with a hedge fund that wants to destabilize the current strategy. The index funds, in a sense, then become kind of the decision maker with the hedge fund on one side and management on the other. Hedge funds, they're not active. They don't ever try to change the company's own strategy directly, but they're the contingent decision maker when someone else steps in to try to do so. Or in a merger, if management proposes a merger, and let's say the buyer's stock price plummets in response, the index funds will notice that and they will say, we may not vote for this merger. This is not looking very good. Tell us why we should vote for it. And they do actively choose whether they vote for or against mergers. Managers, of course, know that. So then they have to design their mergers with the index fund preferences in mind. So in the US, they often, a lot of times they deal with basic elements of corporate governance, whether a company's board of directors should be elected every year or in staggered tranches like the U.S. Senate. But often they also are attached to very politically controversial issues. You name the issue, there's a shareholder resolution at some company every year on it: BDS, anti-abortion, gun control, go down the list. Climate change is the one that really got index funds on the map, because in 2021, there was a proxy fight at Exxon, which followed a shareholder resolution that had been brought 2 years earlier to require more disclosure from Exxon about climate. And in that earlier shareholder resolution, BlackRock, one of the big index fund players, supported the resolution, and as a result pushed it over the majority. And that attracted the attention of a lot of people, including climate activists and also investors. And it also importantly attracted the interest of an activist who wanted to and eventually did run a proxy fight at Exxon, and in 2021 won the proxy fight because of the index funds. And amazingly enough, the proxy fight was run on a platform at Exxon of getting Exxon to be greener. This is a company that had denied climate change's existence until 2014, I think, and then finally had sort of grudgingly put a couple of people voluntarily, in quotes, on its board a couple of years earlier that knew something about sustainability, but it very much resisted efforts for it to do more. 3 of the 4 dissident directors, including a sustainability expert and someone who runs a wind power company, got put on the board of Exxon against the will of Exxon's existing board for the first time in its history, and changed Exxon. It's still not Greenpeace, to be clear. They're still the leading high-cost producer of oil and gas, but they are now putting, tens of billions of dollars into carbon sequestration investments as one way to address the potential transition to a lower carbon economy, and to respond to the investors' arguments that you need to plan for that as a company, because even from our purely greedy, self-interested shareholder perspective, we don't want you getting bankrupted, because, at the end of the day, as oil and gas fades, it's not going to be Exxon that's the last producer. It's going to be Aramco or somebody that actually is at the source. And so the effort by investors was partly, I think, socially, oriented, but I think actually even more genuinely focused on investment interests. And in any event, it was index funds that really determined the outcome there, which was a shock to everyone and really put them on the map politically.
I mean, that's a good example, but maybe I wonder, is that more the exception than the rule in terms of an index provider sort of becoming so active? I'm just wondering if we go back to the principal agent problem of managers running the show at the expense of shareholders. If I was the CEO of a company, I'd rather have 30% of my company owned by an index provider like Vanguard rather than, say, by a hedge fund, because I know I'd be able to run the company more in my own liking than otherwise. So, in some ways, has this led to managers becoming more powerful, ironically?
I actually think probably not. And the reason is, of course, normally it's not a choice between Carl Icahn and BlackRock. it's a choice between, 100 to 1,000 dispersed individuals in other institutions or BlackRock. BlackRock is just a couple people that Carl has to convince that he's right. As opposed to, if you're following like the ongoing fight right now at Disney, Treon is having to go to, millions of individual Mickey Mouse lovers and convince them that the current management team is doing a bad job. Uh, you know, and it so happens that the index funds, they are important at Disney too, but there's even greater retail investment at Disney than would be typical for a public company. So actually it's harder really for Treon to get traction. So I actually think managers probably, they of course would prefer the index funds with their tendency to passivity over an activist hedge fund as a co-owner. But they probably would be even happier to go back to the world in which the shareholders basically just either sold or not if they were unhappy with performance. And I will tell you that in private, managers are, you're absolutely right that Exxon is an outlier event. It's like the dramatic exposure of this power, but the use of the power in the background is constant and pretty, unrelenting. Management has to now talk to the index funds, each of them, a couple times a year, and they get asked questions that they're not being asked in public in the analyst calls, and they have slightly different perspectives on things, and it's just another group of people they have to be accountable to. And then, as I alluded, as management thinks about its strategy choices, who they might want to buy in an M&A deal, they know that if they don't have the goodwill of the index funds, they won't be able to get it done. And so, all else equal, I would say managers probably would prefer them not to have this power, and particularly, obviously, in moments like the Exxon fight. So.
Okay, no, that's a very fair point. I mean, let's pivot over to the other side of the market, private equity. We talked about corporate raiders and such in the 1980s. Now we have private equity. Why did they grow? And they seem to become very sort of accepted today in a way that they weren't, say, 20, 30 years ago. They're just kind of part of the financial industry now. So can you talk more on that?
Yeah, the private equity world it's another type of asset management. I included in the same book because I think there's some really deep commonalities to the role of index funds. Private equity also enjoys economies of scale, slightly different reasons. It's not so much that it's just a simple business. It's not. It's actually a complicated business. But a constant involvement in the financial market, either raising money to buy a new company, raising funds for a fund, exiting by selling a portfolio company, and increasingly these days getting involved in private credit or other kinds of assets besides equity. The private equity funds really are the constant transactional players. So they have economies of scale of information. They know what's going on because they're involved in everything. And because of that, they can actually monetize that proximate knowledge of what's happening in the entire economy, across the economy, the bigger players, that is. I should say private equity is, of course, much more variable than index funds. There's lots of small private equity. There's specialized people who only invest in, food companies based in Iceland. Actually, I don't know if that's really true, but you get the basic idea. But the part I'm focusing on is the really big players, the top 10 or 12, and they I think will continue to enjoy growth because of the economies of scale of information that they enjoy. Now you make another point. I'll just say in passing, previously I think unappreciated part of their rise is a brilliant branding exercise. So they used to be called buyout companies, or even worse, leveraged buyout companies, and that doesn't sound so good if you associate buyouts with risk and failure and bankruptcy or layoffs. They rebranded it as private equity in the 90s, partly because there was a period when doing leverage deals was hard, and they did more growth equity. But they've kept that name. and continued to use it because it sounds great for them. It's private. Like private means leave us alone. Equity, that's upside. That's not taking risk with debt. But their business model is still the same. They borrow money. They dramatically increase the leverage, the financial risk that comes with it. They typically engage in significant cost cutting after buying a company, which leads to layoffs and certain effects on possibly on consumers. And then and having improved the cash flows, they plan to resell in 5 to 10 years. So that's still the basic model. What I think is new, that I tell in quite great detail in the book, is their scale now is such that when it comes time to exit, then they'll sell back to the public market. They sell to other private equity in secondary buyouts, or even more, like, to me, strange, because really new and quite legally fraught, they sell to themselves. They take one fund and they exit the fund by creating another fund or a continuation fund, or they allow some investors in the first fund to roll over with other investors. And so that's a conflict of interest, not to make the obvious point. And so there's real questions, I think, about the current business model that they're using. Continuation investments like that now represent, a third or more in any given year. And they're continuing to grow. And as they get bigger and bigger, like that becomes more so private equity now really forms an alternative capital universe to the public company universe. It's not really private. This is a key point. Their branding exercise is just a branding exercise. If you actually look at where they get their money from the same sources as public companies, because they get their money from pension funds who are investing on behalf of millions of retirees and workers, just like public companies get money from pension funds. They get money from sovereign wealth funds. They get money from other funds. They get, and so actually it's very few individual private equity investors play a dominant role in any given private equity fund. It's dispersed ownership, but it's legally different, and it's treated as private for the disclosure regimes in most countries. And so the thing that I worry the most about private equity, aside from their scale, is that they disclose almost nothing. It's a completely dark part of the economy. I think that has troubling implications for finance. I think an unappreciated but first order benefit of the public company disclosure regime is it allows everyone in the entire economy to get all kinds of information about the economy, which sharpens investment planning and capital expenditure choices and project choice. Even if you're not really valuing, Exxon itself, you learn about the oil and gas industry by reading the annual reports. You take those companies offline into the private equity universe, and you no longer have that source of rich, detailed financial information about the economy. I don't want to overstate it. The private equity, folks are not currently eating into the absolute dollars of the public company world, but as a percentage of the economy, they are growing just as fast as index funds. 10 to 20% compound annual growth rate for the past 25 years, vastly faster than public companies, vastly faster than the economy. And so big players, economies of scale, displacing the public companies altogether. Index funds control public companies to some extent. That's new. Private equity is displacing public companies at a level that has never been seen before. In the 80s, at the peak of the buyout boom that we were talking about earlier, they were like maybe 3 to 5% of the total capital formed and invested. Today, it's more like 20, which is a dramatic increase, and it continues to go up.
Yeah, I have to say on the disclosures and transparency, I have to agree. I give an annual lecture in one of the Harvard courses on PE and how it's doing and compared to public markets. And it's so hard to get quality data on private equity. And so you really struggle to make appropriate, comparisons. So I definitely would like to see more disclosures for at personal research level. But this sort of leads us on to the question of, the political reaction to the rise of these two types of institutions. From the sounds of things, it sounds like private equity would be an obvious target of, politicians, both in terms of disclosures, but also in terms of some of the tax benefits they get in terms of the carry that they have, that they have in terms of how they report their income. Now, has that actually been the case? I mean, how would you kind of describe the sort of the political response to the 12, or the power of the 12 in these two sides?
Yeah, so you're right. Private equity has been the target of a series of political, efforts to take away tax advantages they enjoy. They've got sort of triple advantage. They got the carry, they borrow money, which is tax favored, and then they also derive a lot of benefits from the kind of intra-fund transactions that they, as I described earlier, increasingly use, where they can time and take advantage of the tax attributes of their investments in ways that public companies could not. They're also, as you alluded, the target because they're in the dark and they don't disclose much. And that's just inherently, I think, politically troubling. I'll also mention something else that's increasingly, I think, going to be a challenge for them. As they've grown, private equity funds, they've moved into sectors that they once never would have touched. In the 80s, they bought mid-cap widget makers that, were sort of simple businesses in a basic sense, and they had a standard playbook to improve value. The benefits of that have long been exhausted. So they've now moved into increasingly service sectors, and even maybe more troubling professional service sectors. And here, it's not clear that the private equity model works well as a business matter. And yet I can't really be sure of that because they don't disclose anything. So I'm not really sure. I just can tell you that there are some pretty well-known examples. There's one playing out right now in Massachusetts, actually. A series of hospitals were bought up by a private equity fund, and then now they're going bankrupt. And so they're being shut down. And so I think, putting aside financial risk, there's also just the question of, does it make sense to have healthcare providers who are professionals and supposedly have professional obligations to patients, for example, in a business which is predicated on massive incentives to increase cash flow at the expense of everything? If you're buying a widget, pretty quickly if the widget is working or not. The feedback of the consumer to the producer is tight. And I don't think private equity typically shirks on quality in order to cut costs in that sector, in that fictional sector, you know what I mean? But in a professional service setting, patients often never know whether they got good advice. Like, it's hard, it's a credence good. It's like you hope you can trust your healthcare professional to not overdiagnose or underdiagnose or overtreat or undertreat. And yet you don't really know. And I just, for the listeners, if you go to the dentist, ask yourself, is this dentist owned by a private equity firm, or is it owned by the dentist or by the dentist's family or the dentist's father? And depending on the answer to that, how do you think about when they recommend the discretionary filling replacement that maybe you do or don't need? And you think about the business model that private equity brings to bear on that choice, and it might change the way you think about which dentist to use. But in the meantime, dentistry is one of the major growth sectors for private equity right now in the United States. And I could go through a long list of others. And I just, I'm not saying there's necessarily anything wrong with the private equity run dentistry office. It could be great, but there's no disclosure. So I have no way of knowing. I just, and I will say that there are repeated studies coming out of the public health world that suggest actually outcomes, some of which are observable despite the absence of private equity disclosure. Because when people are killed in hospitals, they have to report that. So there are studies going on, and they don't look so good for the industry. And yet the industry is still growing in those sectors. So that, I think, is that I say all that because I think that's probably the most likely channel of political attack in the near term for private equity. It's going to be healthcare and whether they can actually do well in that sector.
And is there it probably is, but is there a political divide here with the Republicans, Democrats, or do they actually have some common cause here with private equity?
Well, for the political attacks that you mentioned earlier, tax particularly, that's pretty partisan. Although I will say, of course, famously, Christine Sinema, formerly a Democrat, then independent, and now soon to be out of a job in Arizona, she stuck with private equity, even though she was a Democrat. And she was the reason that the carried interest did not get repealed last time. Chuck Schumer, in the Senate, leader of the Democratic Party in Washington, he's also famously quite allied with private equity. So it's not a pure partisan thing, but it is true that it's mostly Democrats who've been interested in the tax reform. I think when it comes to healthcare, that becomes pretty bipartisan. Marco Rubio is interested in this topic. There are other well-known Republicans who've been looking increasingly at some of the activities of private equity with some concern. And then there's one other bipartisan connection, which is pension funds, who I mentioned are the biggest source of money for private equity funds. They are ultimately often, particularly public pension funds, are ultimately contingently channels by which taxpayers have to pay. Because if there are promises to pensioners that can't be met, it's usually not politically feasible to just say, sorry, guys, you're going to have to live in your retirement without your pension. There's some typical taxpayer hook then, which then means that the investments that the pensions are making are of interest to, and Republicans often are quite skeptical about pension investments. And so they too have been looking at, shouldn't there be more attention paid to how the private equity investments are doing for pensions? Shouldn't there be at least some minimum floor of risk return reporting, maybe after the fact, maybe not real time, maybe not anything like a public company, but still something that would allow the public, not just the pension trustees who, are typically, honest people, but maybe are not quite up to the job of looking over the shoulder of KKR. So I do think there is some probably bipartisan interest in some disclosure. And frankly, I think even the biggest private equity firms, they'd be okay with that. Like, I think if it were well designed and not too disruptive of their way of doing business, they'd be okay with some, lagged risk return disclosures, maybe some lagged disclosures about the kinds of investments they're making. I think that's something that is likely to be able to be bipartisan. But in the meantime, you still got partisan attacks, just to be clear.
And on the index fund side, is there a political reaction to the rise of these index funds or not? Yeah, I don't feel like I hear about that much, but
yeah, absolutely. The red states in particular got very angry about the Exxon proxy fight I described earlier. And they have also become very interested in different places at using the power. So it's both, there are attacks on index funds. So 25 Republican senators two summers ago proposed a bill at a hearing that would have taken away all the votes from index funds. So they would be able to hold the stock, but they wouldn't be able to vote it effectively. There were some nuances to the bill, but that was really the bottom line of it. It didn't advance because I think it's a bad idea from many angles. It would disrupt the index funds, which I think are wonderful financial tools, and most people like them as financial tools. And if you took away their votes, that would interfere with the way they manage their businesses. It also would be strange for managers of public companies, because if you take away the index fund votes, effectively the votes go to whoever else owns the stock, which might be fine until Carl Icahn comes along and suddenly his 5% gets tripled because the index funds. So I'm not sure in the end that the business community really liked the idea. But the very fact that 25 Republican senators got together on a bill to take away the vote shows you actually this is a political reaction. And it's played out in other ways. Some of the red states' pensions have been directed by the governors to divest from BlackRock because of its position on climate change. There are other issues. But then weirdly, there's also attempts politically to use the index fund power to advance political goals. So there's a right-wing shareholder resolution proponent right now trying to get companies to vote on anti-abortion and other similar Republican political cause resolutions, and now they're lobbying the index funds to support them. So they're both attacking the index funds, but also trying to use them. And the same is true on the Democratic side as well. So, from my perspective, I worry. I think the index funds, as I said, just to repeat, I know Vanguard doesn't always believe me when I say this, but it's true. I love Vanguard. I invest in Vanguard. I tell my children to invest in Vanguard. I want Vanguard to keep going. I worry about them. I worry that they'll get caught up in a moment of political reaction and really have the business model hurt because of the political response to what they do. And it could come from right or left. I mean, just to be clear, sometimes the positions the index funds take, the Democrats don't like. So if you've got power, which they do, that attracts political attention. And I think we're in a period now where I don't think there's a market equilibrium that will kick in until they have control of 50% or more of the votes of every listed company. So that means their power is going to continue to grow, at least the possible power they have. And that's going to attract more and more political attention. And so, all right, what to do about it? For private equity, sort of the first pass answer we've already covered. It's easy. Just light disclosure, a little bit more transparency, show the world that you're actually worth the money you're attracting. For index funds, it's more complicated. They already disclose a lot. It's not like they hide their votes. They're public. But I do think they could do more earlier in the cycle of a given political issue to open themselves up to comments or suggestions from their own investors. They're trying to do this in part through a thing called voting choice at BlackRock. It's got other names at the other index funds, where it sounds like they're passing the votes through, but that's not really what they're doing. They're letting their investors choose from some policies that they pick, a family of policies. And the policies then would be used to guide how they vote on some of the resolution votes. The policies don't say anything about mergers. They don't say anything about activist fights. They don't really take away their true governance power, but it does at least have the potential for limiting some of their resolution-related power. As of now, I will say they're not quite there yet because the policies all, to me, look pretty similar. There is not a kind of right-wing policy and a left-wing policy. They're all kind of centrist. If you looked at them all and took the names off of them, I think you'd have a hard time distinguishing them. So there's more work to be done, let's just say, in the space. But I do think that's probably the right kind of approach. Some kind of soft consultation process to at least be able to truthfully say, we're not just making these political decisions by ourselves in some dark room somewhere. We're actually taking into account, the range of interests that our own investors have.
And your book, you talk about the power of financial institutions. You don't talk so much about investment banks like Goldman Sachs, JP Morgan, which of course, do exert a lot of control. I've worked before McArive, I worked for all the big investment banks. So, they exert a lot of control and influence as well. I mean, why didn't you have a third kind of section of the book to talk about investment banks?
I'm, partly, frankly, their role is not new. So as compared to the rise of these two asset management companies in corporate governance, I don't think their influence has gotten more powerful over the last 10, 15 years. And I don't see any sustained path to yet more power. In a lot of ways, the private equity industry, and this is part of the story I do try to tell, has taken out of the banks a lot of the source of value add that used to exist in the banks. And hedge funds to some extent. I don't cover hedge funds either because they're yet another and distinct thing, and they're not growing quite in the same way that the two funds I do talk about. And so while look, Goldman is still Goldman. It's still quite the gorilla. I'll just put it this way: single biggest source of Wall Street fees, the fees that these banks that you just alluded to charge, private equity, not GM or Exxon. It's the private equity industry. I think today, really, to think of Wall Street as an entity, it's to think of it as Goldman. No, that you're missing the picture. It's KKR and Apollo and so on. Yeah, Goldman's there. It's part of the mix. It's part of the ecology there. But it's not growing very fast. And of course, the big systemic banks now, because of Dodd-Frank and because of the crisis that preceded Dodd-Frank, are much more heavily regulated. And if you take the, average MBA and you say, if you could pick any job, 5 or 10 years into a career that you would like, they don't say Goldman anymore.
Yep, it's changed. Yeah, you're absolutely right. I mean, I think the global financial crisis changed things a lot, where banks, investment banks, de-risked, and all kind of sort of talent, you could say, went to private equity on the one side, and then on the other side, they went to hedge funds, on the public market side. And then obviously the rise of index funds. So banks have kind of been defanged, you could say. But you rightly do point out, if you look at the growth of asset management, it's index funds and PE, private equity. So that's the delta. That's what's changed. And that's the dynamics we have to care about. Now, I did want to round off with a couple of personal questions. One is you're obviously at Harvard, so you interact with lots of students and such. I mean, what advice do you give to younger people who are going to graduate college this year, enter the real world? What would you tell them?
Well, I tend to think that this is, partly my own biography. Money's important. I earn a good living. But it's one thing. And I think of even more, certainly as important component of a well-lived life and a career that you enjoy is some actual real substantive interest in the activity that you're engaged in. So finance, can be quite rewarding, and there are roles in finance that also attach to important things beyond purely, raising capital for the purposes of future investment. And so I encourage people to think, like, what kind of skill set do I want to develop either in a first job or by going back to school, or maybe some combination that could let me connect things I care about as a human with, a rewarding and successful career. And so, look, and if you just think about our world today, I do think climate change is a source of a lot of interesting ground level shifts in industry. So knowing something about energy, knowing something about supply chain management and globalization and how it's actually functioning, the technology that's driving solar power costs to the lowest level ever. So low these days, actually, people are worried that there's not a sustainable business anymore because China's going to make all the money in it. But knowing the technology side of it, knowing, and then, the other would be healthcare is another one that I get people to think about. Finance is really important for healthcare revolutions. Biotech is the sector that you can make a ton of money, and it's also really hard and interesting, and it saves people's lives. So those are the kinds of things I encourage people to think about. Where are the sectors of the economy that need finance? So if you're interested in finance for its own sake, there's a role there for you, but which, are a little more than just purely finance for its own sake.
No, that's great. Now, you've, of course, written a book, but presumably you must read a lot of books. I mean, what are some of the books that have influenced you, or perhaps books recently that you've come across that you thought, that's a really interesting book?
So I just reread, because it's now a Netflix series, The Three-Body Problem, which is a great science fiction trilogy written by a Chinese national. And interestingly, the Netflix thing apparently is quite controversial in China because they, changed some of the characterizations. the great thing about that book is that it takes you through a lot of standard science fiction tropes, but it also gets you to think really hard about fundamentally political science. It's embedded in there. There's all kinds of interesting embedded questions about China, which is, a major factor of our lives and will continue to be. And so if you haven't read it, it was on Obama's short list. That's how I originally got to it, but it's also something that's on the short list of people who are very different from Obama, like Peter Thiel. So it spans a whole bunch of, and has attracted acclaim for good reason. If I go farther back in time, I still love history. I think repeated consumption of history in various forms is a great complement to, financial modeling and economics, which are great at stylized theory, but a little short sometimes on empirical reality. And history is the opposite. It's often like just a mess. It's one damn thing after another, as it's famously said. But if you read enough of them, you kind of get it's like a virtual way into living many lives, and then that helps you think about what's realistic about some of the models that are quite dominant. And so I love the Wolf Hall series, which is 17th century British history. But when I went to the SEC, oh, this is the world I just read about under Henry VIII. It's amazing, actually, how common. No, we don't behead people typically anymore, so we have progressed a little bit. But some of the internal dynamics within bureaucratic agencies, just like they jump right off the page from that era, and there are similar kinds of histories windows onto organizational dynamics. So there you go.
Yeah, no, that's fantastic. So that's great. I do urge our listeners and viewers to buy your book, The Problem of 12. Aside from that, what's the best way for people to follow you and your work?
That's, I should have a more ready answer to this question. My assistant keeps telling me I should have a blog, but I don't. So there's a thing called the Harvard Law School Corporate Governance blog, which is it's probably the best. I don't say that just because it's Harvard. It's not even my baby. I'm attached to it. It's other people's thing, but it's the single best place to go to follow corporate governance. It's law firms publish there, banks publish there, financial economists publish there. There's short little blog entries, usually with links to real research. And whenever I have a new thing, it'll go there. Sometimes I go to the Columbia University Blue Sky blog, it's called, because in all candor, they're faster at getting things out than my friends at Harvard are. And then I also, will not infrequently generate research that the business school here at Harvard will publicize. So if you're tracking Harvard Law, corporate governance, Columbia, Blue Sky, and the business school at Harvard, anything I publish will pop up one of those places.
Okay, that's excellent. So once again, thanks a lot. It was a really enlightening conversation, and well done on the book. It's a fantastic read, and good luck with your future research and your future books as well.
Well, thank you so much for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.